All right. Today is Thursday, June 1st. We're starting fresh, folks. And this is a recap for the stock market activities today. Folks, I got a good one for you tonight. And let's start with this. Apologies for the mess of a programming schedule that I've been doing for the last 2 weeks. But I've been traveling a lot and I have people visiting, so it's a mess out here. But rest assured, next week I won't be traveling and you will see the deluge of videos I've been working on heading your way. We're going to put Janet Yellen to shame. But let's start with this. Perhaps we are witnessing the most distorted rally in stock market history. The headline reads, the S&P's 500's gains are almost entirely from just 5 companies. So when people say, oh, it's a bull market, here it is, we got the bottom, soft landing is coming, yet the majority of the gains coming from 5 companies. You take these out, the majority of stocks are actually down for the year. When you look at the entire market capitalization of the S&P 500, which is the U.S. stock market, about a quarter of the entire value of the U.S. stock market is coming from 5 companies. That's it. And of course, this opens the debate. The bulls will look at this as, well, there's no problem. The concentration is not really a problem. The best companies are leading and they're pushing the indices higher. There's nothing to see here. The bears will look at it as a warning signal that perhaps what we're seeing is a bubble forming within a bear market. And this bubble is concentrated in the largest 5 stocks in the market. And once this bubble bursts, it will take the entire market and the economy down with it. But hold your horses before you say it's a bubble. You might want to listen to the good professor from Wharton, Jeremy Siegel. He does not see a mania around the AI stocks. He does not see it as a bubble at all. The good professor says, while these tech stocks may be overvalued long term, no one can predict where they're going to peak. He said that Nvidia, a beneficiary of the boom, was a real good company, quote unquote, with blowout earnings. Are you saying that revenues down 13% plus year on year is blowout earnings? Or are you talking about the fantasy? Are you talking about the outlook that they gave us, which we have no idea is it going to be true or not? Are they just huffing and puffing, or do they have tangible pieces of data and orders that they can base this guidance on? And of course, a reminder, the good professor, you're going to take whatever he says with a grain of salt, because back in 2008, he said the same thing. Don't count on a recession, but look for stocks to have a good year and Democrats to take control of the White House. Well, at least he got one thing right. But let's talk about the tape, shall we? And again, this is my midday report. You can pause this and read it for yourself, but I'm going to summarize it for you. I've been talking to a lot of money managers since the morning, early in the morning. What do you guys doing? This is the beginning of a new month, lots of rebalancing. What are you buying? What are you selling? And I got different answers. Some would say our clients are saying buy the AI mania. Nvidia, we don't care. Just buy them. And the managers will have to buy. And therefore, you see a stock like Nvidia bouncing higher by about 5% today. Others talked about, buying the dips in Chinese stocks. Maybe we have reached the bottom in the expectations about the Chinese economy. Others bought oil. Some say, the Fed is going to pause. This is going to be good for regional banks, and they bought dips in banks. So we have different theories here, and everybody's excited today. So we see the tide that lifted all boats. Pretty much everything closed in the green today. It was a good day all in all. The breadth was actually pretty good. But was it a rotation? The answer is it was not a rotation. Why do we care about the rotation, Maverick? The rotation is the confirmation whether we have a bull rally or not. What we got today is just inflows based on what the managers were buying. And of course, the retail crowd chasing, using call options. So many tailwinds here, even for the shittiest sectors of the economy. The managers were buying. But what I said is be careful, because they get excited in the beginning of the month. For example, they buy China, they buy oil. And then we get more bad news about China, more bad news about a recession. We see these stocks going down. They buy AI right now. Then we get bad news about AI, and maybe this is a bubble. Maybe somebody big who was a proponent for these stocks comes out and changes their minds and say, okay, I'm out. I'm selling some. I'm taking 50 off, whatever they say. And that could take them down. We also talked about, on top of the managers buying, we also have the 0-day till expiration options. This is how the retail crowd and some institutions are participating in these rallies. Call options, 0-day till expiration, but nothing really with conviction. But we have to count the impact of 0-day till expiration options on the tape every single day, because they have huge volumes and they move the market one way or the other. So in summary, we talked about the SPX, for example. The majority of the 0-day till expiration options hit the target of 4,200, which means that the market maker will attempt to drop the SPX below 4,200 by the end of the day to make the majority of these call options that haven't been closed yet expire worthless. But they're facing also a tsunami of buying from the managers and the retail crowd alike. And you can see by the end of the day, if we look at the SPX 3 minutes chart, the market maker tried to push the SPX all the way down to 4,200. But we have a lot of orders coming in from the money managers, from the retail crowd, and the market maker could not take it all the way down to 4,200. Now, what's important for the market maker is the weekly expirations. And we know that the majority of them, 4,200, are in the money right now. So they're going to give it another shot tomorrow in pushing this chart down below 4,200. We'll see what happens. But most importantly, since now we're looking for rotations, we're looking for money managers taking profits from some and buying others. So I floated the question for you. Amid the buying frenzy, what are you buying? What are you guys buying? Does it match with what the money managers are buying or not? And I gave you a few choices. Most of you, no love for AI. Nobody wants to chase AI. Big caps, we have some. But most of you said you're going to chase dividend stocks now, that yields are going down. And then at number 2, the defensive stocks. Number 3, healthcare. And then you got the big caps. Number 4. And then at number 5, oil. So we have a diversity of responses here. Now my choices, and I could be wrong, so please don't follow me unless you do your own homework and you agree with me. If I'm going to buy anything right now at this stage, first of all, I'm not buying stocks. I'm using call options. And if I'm buying anything, I'm buying the battered, bruised, unloved stocks, which a lot of them happen to be in the Dylan Mulvaney ETF. And therefore I said I'm rotating to the Dylan Mulvaney ETF. I'm buying the dips in TGT, Target, Disney, DIS, BUD, Budweiser, LU, Lululemon. All calls. No stock positions. And you people think I'm joking. I'm not joking. I can show you the receipts. I sold some of my STZ Constellation brands and I bought the dip in BUD. I could be wrong. I could eat a massive pie tomorrow. But I'm just saying, if I'm going to chase anything here, I'm chasing the battered and bruised. And a lot of these names happen to be in the Dylan Mulvaney ETF. So let's take a look at some of these names. TGT Target, here it is. We've been waiting and waiting and waiting when it's going to stop. Today we got the stop. A green candle for once. Way oversold conditions on the RSI. And look at the volume. Lots of volume came in today. Classic reversal signal. Is it guaranteed? Is it in the bag? Not really, because we have a retail apocalypse. But if you're a technician, if you're looking from the technician lens alone, it is a classic reversal signal. Then we look at LU, Lululemon, way oversold on the daily. We got earnings after the bell, and I believe the stock is up about 10 to 11%, something like that. So we have a rebound on this one. But bear in mind, folks, this is not a conviction from my part on the retail sector of the economy and the stock market. If we look at the XRT, for example, this is the retail ETF. Way oversold. We have a gap at 58.57. We could see a pop higher to close this gap, maybe a little more. And then they suck a lot of people who say, okay, XRT is bottoming. The problem is it could reverse right away and break the support at 55.26. And the reason is, if we zoom out to a weekly chart, look at this. Classic head and shoulder formation, and the RSI is not really oversold. It could get even uglier for retail. Look at what happened today from Dollar General, for example. That name crashed, and before that, Advanced Auto Parts. That name is down almost 50% in about a few days. So we have a retail apocalypse going on. Every single company in retail showed a lot of weakness. So you got to keep that in mind when you buy these dips. Now we look at BUD, Budweiser, way oversold. Look at the volume. In the last 2 days, classic reversal signal. Lots of volume showing up here, buying the dip. Is it going to be 100% in the bag that this is the bottom in BUD? Not really. But from a technical standpoint alone, it is a reversal signal, and maybe we can catch a rebound rally from this point on. And you got to remember this. The company Anheuser-Busch is not just Budweiser or Bud Light. They have plenty of other beers, also craft beers, so it is a diversified company. And sure, the backlash is hurting them a lot, maybe deservingly so. Classic marketing mistake, but at some point it becomes ridiculous. At some point, we should at least look for a rebound and some short covering. And then perhaps the weakest case in the Dylan Mulvaney ETF is DIS Disney. We look at the daily chart. Sure, the RSI is moving higher, firming up. It was not really oversold to begin with. So is the MACD. So maybe we're seeing some signs that Disney is about to go higher, at least in a rebound rally. We're not looking at closing the gap above. We're looking at a few bucks here and there. 90, 92. Tamper your expectations. And the reason is, if you zoom out to the weekly chart, look at this. Stock is not really oversold. And what if this is a classic, yet again, head and shoulder formation? And there is more pain to come. Now, The rotation I'm talking about and looking for is a major rotation in the stock market, not the Dillon Mulvaney ETF. I'm talking about flows stopping and getting out of technology, getting out of the big caps and the AI mania, and chasing the cyclical side of the economy, the oils, the metals, the reopening names, the industrials, because that shows conviction by money managers that the economy is indeed heading into a soft landing. But if they're not putting their money where the mouth is, then it's more evident that what we're seeing right now is just a bubble within a bear market, and nobody has conviction on the underlying economy. And then this money will be taken out of these big cap names and the AI mania, and it's going to stay in cash, money market funds, or T-bills, since rates are now attractive. But maybe they're not going to be attractive for so long. You know why? Because the Fed is announcing a pause. It's quite peculiar, if I'm honest with you. Here's Lisa Bloomberg. She says the growing consensus in market, the Fed will probably keep rates steady this month, but may hike one more time in July. This is all bullshit. I'm talking about the Fed right now. These games, these mind games that they want to play. And they think all of us are dumb. They mince words all over the place. Oh, it's transitory. It's soft landing. We're going to be nimble. These motherfuckers play with the words like I've never seen before. And now it's becoming laughable. If we look at the odds, the 525 to 550, just a few days ago, we were talking about a 70% chance that the Fed will raise rates by 25 basis points in the next meeting. The odds now collapsed to below 20%. So the consensus right now is for a pause. Now, we know that a couple of weeks ago, Jerome Powell came out with the papers, reading from his handlers, shaking, twitching, drooling all over the place. And his goal was to convey the message to us that the Fed will pause, but nobody bought it. So why are we buying it right now? The answer is more Fed zombies came out hammering the same message, that the Fed will now skip. That's the terminology for now. It's skipping. We're not pausing, we're just skipping. We're taking a break because we've been working so hard. We're going to take a break and see what happens. I think Chairman Volcker is rolling in his grave right now. You're going to take a break when inflation is more than double your target? And this is, of course, coming from Vice Chair Jefferson. He says, yeah, we're just going to skip in the next meeting. We're going to take a pass. And then came another zombie from Philadelphia, Harker. He got the orders from his handlers. And he also now says that he wants to skip in the next meeting in June. And of course, former Fed President Dudley, he just broke it down for us. If they say skip, they actually mean a pause. But they're playing with the words because, number one, they don't want the market to rally and go to extremes. I mean, it's already going to extremes right now. Number two, you know what? Let's pass on number two right now. Let's skip number two right now. Let's hear what Dudley has to say, and then we talk about number two. Here it is.
Bill, the implication here that the Fed hasn't really accomplished much and that they should go further with respect to hiking rates, that perhaps a pause or skipping or whatever you want to call it is perhaps not the right approach. What's the consequence to that? Do you expect this to actually accelerate inflation or keep it higher for longer in a way that people aren't really expecting?
It doesn't really matter if they hike in June versus July, as long as they keep financial conditions from easing significantly. And I think that's why they're using the language of skip rather than pause. They don't want the markets to think that they're finished because they don't want the stock market to rally a lot, bond yields to fall. If that were to happen, that would make monetary policy, the impulse of monetary policy, more stimulative and would be counterproductive to what they're trying to accomplish, which is to cool off the labor market.
And of course, the skip thing is coming from the Fed sponsors. The Fed works for the banks, and the biggest bankster in the country is Jamie Dimon. And he came out and said, take a pause, but we don't think it's possible that they're going to have to raise a little more. And of course, the Fed says, okay, Dimon says pause, we're going to pause. We got the orders. But let's talk about number two. Number one is they don't want to get the market too excited and loosen financial conditions in a frenzy. I mean, the frenzy is already happening. But number two, which I believe this is the real reason why they're skipping. They see a disaster coming if they raise rates, and they want to avoid it. They want to buy a little more time. The disaster could be the massive deluge that's about to come from the Treasury, the $1 trillion plus of a liquidity drain. That could shock the market, and that's the equivalent of about 25 to 50 basis points. So the Fed doesn't want to add on those 25 to 50 basis points. And that leads to the other explanation, and perhaps they're both tied up. They see tremendous financial stress in one corner of the economy. Could it be banks again? Could it be commercial real estate? Could it be zombie companies? Could it be a larger bank? Could it be whatever? They see something big about to blow up and they want to buy more time. They see if the Treasury indeed releases the deluge and then they do 25 on top of that, that thing will blow up. And if it blows up, it will be a disaster for the economy. But here's what the Fed is not really looking at right now. This game of playing word salad and saying, oh, it's a skip, it's not a pause, please don't take it as a permission to go bananas in the stock market. And by the way, in the commodities market, the market is not going to buy any of that. The moment they say skip, the market is going to start pricing in rate cuts immediately, and the market will go crazy. And if we've seen anything during this AI mania, we know that there is a massive amount of liquidity that's still yet to be sucked out of the economy. Now this liquidity is chasing the big caps and the AI mania. But what if the Fed pauses and signals that they're done, and maybe they're going to start cutting, while the fight against inflation is not over yet? And inflation has all the conditions, all the foundations still intact to rev back higher. This massive liquidity that yet to be sucked out of the economy could rotate and chase commodities as the Fed sends the wrong signal. And then we see the oils moving higher, copper, grain, softs, meats. And here we go, a revival in inflation. The Fed will have to come back and say, whoops, we made a mistake. Now we have to make up for that and do 50 basis points instead. This is a very dangerous game, folks. And of course, they're announcing this skip before even getting tomorrow's jobs report, which could be a shocker. And since we're talking about the jobs report, let's talk about macro, because we have some leading indicators today. For example, we got the ADP employment report, and if you look at that one, the private sector of the economy, while wage inflation cooled down a bit, for job stayers, it's up 6.5%. For job changers, up 12.1%. If you have an ounce of a brain, you know that this wage inflation will be reflected in actual inflation in the economy. These people are just not taking wages and hiding it under the mattress. They're using all of this money to compete in the economy. For rents, for mortgages, for cars, for goods, for services, and that will cause more and more inflation. The number we got from the ADP exceeded all expectations, 278,000 jobs created in the month of May. We will look at natural resources and mining, for example, up 94,000 jobs, construction, up 64,000 jobs, manufacturing, down 48,000 jobs. This is the recession part of the economy. It's in manufacturing right now. If we look at the services sector of the economy, again, the majority of gains are coming from leisure and hospitality, with more than 200,000 jobs created in the month of May. These are the shittiest jobs, the most sensitive kind of jobs. Sure, they pay a lot right now, but the moment the economy slows down, they're going to get rid of these jobs so fast. If you own a restaurant, a bar, you know what I'm talking about. Now you're having a problem finding employees, and you have to pay more. But your books are unsustainable, because either you have to jack up prices on your clients, on your customers, to make up for the increase in wages, or you're eating a bag. So the moment you see a slowdown in the economy, consumers are not showing up anymore, you gotta get rid of these employees so fast with their inflated wages. When we look at the small business side of the economy, up about 240,000 jobs, mid-sized, up about 240,000 jobs. But large employers, they noted down 106,000 jobs in the month of May. And typically in any cycle, what we see is in a recovery, for example. Forget about the pandemic recovery, that was the exception, not the rule. Usually we see a trickle-down effect. The recovery happens in big companies first, large employers. As these workers start to recover, get their jobs back, get their salaries back, they start spending in the economy. And then we see a recovery in mid-sized businesses and small businesses. So there's a trickle-down effect. And the same happens in a recession. Larger companies lose employees first. Those employees might have severance packages, and they can still spend in the economy. But at some point, they're going to run out of spending power. And when they do, you see the trickling down to mid-sized and small businesses. They start to see a slowdown in business, and they have to get rid of employees. And again, among the slew of economic data that we got this week, U.S. construction, that remains a hot sector of the economy. We have a massive shortage in housing, so construction is really hot. That's inflationary. And we also have the drop in home prices according to the Case-Shiller Home Index. The declines are finally stopping. Now we're seeing prices moving higher again, and the Fed wants to pause, by the way. Watch this chart making a higher high a few months after the Fed pauses. So inflation is going to rev higher in housing, in services, and many other sectors of the economy. That's the hot side of the icy hot economy. Then there is the icy. The icy is, for example, the Chicago Business Activity Barometer hit a 6-month low in May. And then, of course, manufacturing, that's a disaster. Today we got the PMIs, they're going down big, but the good news is inflation is easing, so prices are down a bit. Now, you might read this and say, okay, Maverick, we have the icy hot economy, we get it. But shouldn't that make the Fed more incentivized to pause, to see what's going on? The answer is, if they do pause, here's the risk. we could see a massive revival of inflation in the hot side of the economy. The services, leisure and hospitality, travel, construction, housing, autos, food, apparel, all of these prices could move significantly higher. But in the icy side of the economy, the risk is creating more and more stagflation. If the Fed pauses, we might not see a recovery in headline manufacturing, for example. What we might see instead is, remember when we talked about the liquidity? If the liquidity chases commodities, then we could see prices moving higher for manufacturers and for goods because oil is going to be higher, copper is higher, meats, grains, softs, everything's going higher. And then you have a worse phenomenon. You have a stagflation on one side. The icy is no longer just icy. It's stagflationary. And the hot becomes really hot. It becomes hyperinflationary. And ladies and gentlemen, the key to defeating this inflation is the gap between the icy and the hot. You see, when the Fed raises rates and tightens the monetary policy, for now, they're hitting the icy part of the economy. But they need to do more and more and more to close the gap between the icy and the hot. So the hot side of the economy can join the icy, and inflation is gone out of the economy. If they pause right now, the gap between the hot and the icy will expand further, which means that the Fed will have to come back and do even more than they initially thought. So maybe when Demon says, oh, rates will go to 6, 7, maybe more than 7%, maybe he's not joking. Maybe he sees what's going on. They pause, inflation comes back, and we have to raise rates to 7+. Why are we pausing right now? Something needs rescuing, and we're going to sacrifice a huge part of the economy. We're going to sacrifice the risk of inflation reviving higher and more rate hikes to come to save that something. And of course, we know that the Federal Reserve and their manipulation of markets and the economy is the key behind the suffering of the American people, is the key behind the largest inequality gap in the history of this country. The Fed's manipulation and intervention of the economy is the key why we're seeing housing right now the least affordable in history to the American public. And of course, the Fed is the key behind these kind of headlines. For example, many Americans face hunger crisis, quote unquote, as food insecurity rises. But rest assured, your beloved politicians and your government is coming to your aid with about $300 million worth of assistance. Oh, I'm sorry. That's for Ukraine, not for you. You suffer, you keep your mouth shut, and if you're hungry, let them eat AI. Who cares about these bummies anyways? Now with that, folks, let's move on to the coverage of the stock market, and we begin with the closing of the indices. And here we go. The Dow Industrial Average closing positive by 153.30 points, or a gain of 0.47%. The Nasdaq leading the pack with 165.70 points, or a gain of 1.28%. The S&P also positive by 41.19 points, or a gain of 0.99%, almost 1% even. We look at the sectors all in all, positive across the board, much better breadth than we've been having for, let's say, weeks or even months. And at number 1, capturing the gold medal, materials, number 2 for the silver, energy, number 3 for the bronze, cyclicals. And the laggards, led by utilities, the only negative sector for the day. Even though yields went down, but no love for utilities today, because it happens to be the defensive. Meanwhile, now, at least for today, the assumption is we have perhaps an expansion theme coming. The Fed is pausing, we got the AI mania. All of this led the market right now to assume that we have an expansionary theme, in which we're seeing the cyclicals moving higher, including energy and metals. So it is encouraging right now. But for a real rotation to happen, you need to see technology down. You need to see communication services down, because this means the money's coming out of these sectors and moving into metals, energy, cyclicals. This is not what we've seen today. All what we've seen is we have different money managers. They all have different scopes and different outlooks. And everybody bought what they liked today. Those who liked energy, they bought the dip in energy. Those managers with clients who say, hey, you got to get me into AI, they bought AI. They bought technology. So this is what we've seen so far today. We'll see if any of these themes stick or not. When it comes to the breadth, all in all, pretty good. NYSE 71% advancing versus 27% declining. The Nasdaq 62% advancing versus 34% declining. When we look at commodities, up in the green across the board. The dollar is down big. The Fed is talking about a pause. You combine this with the overbought conditions on the chart of the dollar, at least in the daily, the hourly, and you have a big pullback in the dollar, down about 0.75%. This was good for the majority of commodities across the board. But specifically metals, we got a rebound in copper worth about 2%. The precious metals, gold, silver, platinum, palladium, all doing pretty good. We even got a rebound in energy. Look at that. The dips are being bought. WTI up about 3% for the day. Brent up about a little over 2.25%. Heating oil was also up by about 3%. The losers, you got nat gas down about 4.5% for the day. But mind you, the futures are really volatile. The stocks, nat gas stocks, been outperforming futures for a long time. Matter of fact, a stock like EQT is actually up for the year. Then we got gasoline RBOB, that's down for the day, be it modestly. Now the picture could change quickly, and this is why we say we've been in a thematic market, which is very dangerous. Because if you assume based on the action we got today that you can make investment decisions, you could be sadly mistaken. Example, we got an important catalyst coming out tomorrow, which is the non-farm payrolls. If those come out hot with hot wages, we could see the dollar moving higher again and commodities moving down. So keep that in mind. Moving on to the big casino, the options market, what do we see here? Explosion in call options volumes. Now we have the retail mom and pops chasing these moves, buying a lot of call options way out of the money with shorter expiration dates. They're hoping that they're going to spend a few cents here and there and hit the jackpot. And this is a sign of a speculative frenzy, which usually happens right before the market changes its mind and moves in the other way, meaning a pullback if not a reversal. It happens because the smart money takes profits and they hand the ownership of these stocks to the retail mom and pops who tend to buy at the tops, sell at the bottoms. But wait a minute, Maverick, you just said that the managers were buying today. Yes, they're buying. And they will continue to buy, but they buy for 2 to 3 days in the beginning of the month to make their clients happy. For example, if you have a client who says, hey, NVIDIA went higher by 100%, I missed out on the rally. Okay, so you buy NVIDIA for them for a day or two. They make 5, 6, 7%. Now they're happy. And most managers would say to the client, okay, we made enough money. The stock is becoming really overbought right now. Maybe we should take profits. What do you think? And usually the clients at that point are more responsive. And therefore we see the smart money dumping, dumb money, meaning us, buying. In any case, the hottest stable by far remains Tesla at number 1 with about 2.5 million contracts traded today. About 63% of those were calls. NVIDIA at number 2 with around 1.2 million contracts traded today. About 59% of those were calls. Apple at number 3 with around 1 million contracts traded today. About 64.5% of those were calls. We look at the unusual activities that took place in the options market today. We begin with the IWM small caps, the Russell 2000. Somebody sees it going down again, and they bought the 157 puts for the expiration date June 30, with expectations that the IWM will go down and lose more than 10.5% of its value by then. They paid about 45 cents a piece to enter this trade, all in all spending about $1.3 million. And then what about the trade for the ticker WYNN Wynn Resorts? Now I always go to the Wynn when I'm in Vegas and it's always busy, so we know that business in Vegas is really hot. Now when it comes to Macau, that's a different story, and therefore the stock took it in the chin recently. But is it time to buy the dip? At least according to one trader here. Yet if we look at the chart, the daily chart, sure, it is getting oversold. Maybe you could trade it here. But be careful because we look at the weekly. The reversal process has just begun. We could see the stock going down all the way in the most extreme case to the 80 if not 75. So you gotta be really, really careful here. Anyhow, the trader bought the 105 calls for the expiration date July 21st with expectations that the name will move higher and gain more than 9% by then. They paid about $2.50 a piece to enter this trade, all in all spending about $1.4 million. And then what about the ticker TSLA, Tesla the Souffle? Pretty hot recently, closing above 200, which should make you bullish, but is it getting a little too hot or we're about to see a reversal coming? Because the majority of the buying is happening by the retail mom and pops, and they buy way out of the money call options with shorter expiration dates, forcing the market maker to induce a gamma squeeze. But what happens as we get closer to the expiration date? As we talked today in Discord, the majority of call options, despite being really close to the money, some of them actually in the money, but they lost value anyways due to the IV crush as we get closer to expiration. And if the holders of these call options capitulate and say, okay, take the loss, move on, even though the stock moved exactly as we anticipated, the mistake is we overpaid for these premiums. If they move on and we don't see a lot of following up in buying call options in Tesla or shares, then we see a rug pull, an air pocket of some sort, because what lifted the stock higher is no longer here. There is no organic buying. It's only happening by the shorts and the market maker. And when they're done, when they see the options market done with the squeezes, no more demand, they sell. And the stock goes down, and hence the rug pull. Somebody's bidding on that, and they bought the 185 puts for the expiration date, June 30, with expectations that Tesla would go down and lose more than 11% of its value by then. They paid about $3.65 a piece to enter this trade, all in all spending about $1.4 million. And then what about the ticker NVDA NVIDIA? Somebody sees it going higher, and here comes the speculative frenzy. They're overpaying for these calls, by the way, by too much. Unless the stock keeps moving higher by 10% each day, it's almost impossible to make money from these calls. But here it is. Somebody bought the 455 calls for the expiration date, June 30, with expectations that the name will go higher and gain more than 14.5% by then. They paid about $6 a piece to enter this trade, all in all spending about $2 million. Last but not least, at the bottom of the table, what about the ticker MU Micron? Another speculative trade here, betting for more squeezes, more gains to come for chips. China banning Micron, who cares, right? Until we have to care. But anyhow, somebody bought the $80 calls for the expiration date, August 18th, with expectations that Micron will move higher and gain more than 16% by then. They paid about $1.80 a piece to enter this trade, all in all spending about $1.5 million. We move on to the heat map analysis. What do we see here? A sea of green for the most part. Lots of buying by the institutionals, by the mom and pops, by options traders. And a lot of dips being bought today, be it in oil, be it in metals, in gold miners, in industrials, in the majority of healthcare. Of course, we have AbbVie and Amgen, two names that I do like, but they're involved in this merger and acquisition fiasco with the FTC, so they continue to go down, at least for now. Some bought the dips in regional banks, in actual banks, but no love for Goldman Sachs. Goldman Sachs is facing a lot of trouble with the layoffs. When a company announces layoffs right now again, it means the results are not doing pretty good, even though the market is hot. How could you underperform in this market? It means that Goldman Sachs has a major problem. And then we see dips bought, for example, in the Chinese names, Alibaba, Pinduoduo, JD. A lot of the cyclical names, the lodging, cruises, airlines. A continuation of buying and chasing the frenzy in the AI mania, be it the big caps or chips. The laggards, once again, we talked about Goldman Sachs, AbbVie, Amgen in healthcare. In technology, we have CRM, Salesforce, that's due to earnings. The same can be said with CrowdStrike. Cybersecurity name also down due to earnings, but it managed to close at the highs of the day. AVGO, Broadcom also down, another chip name involved in the AI mania. And of course, the retailers, it's a massacre in retail, be it Nike, be it Ross stores, be it the auto parts stores, all down for the day. And of course, Dollar General, the ticker DG, a disaster today. No love for the yield-sensitive names today, real estate, utilities. They consider those defensives. Today was not a defensive type of day. When we look at the heat map for the ETFs, again, much better breadth today. You see participation from a wider range of ETFs, whether we're talking about energy or gold miners, silver, banks, retail, cyclicals, biotech, metals, all participating. Whether we're looking at the big caps, mid caps, value, small caps, all participating. International markets, green across the board. Of course, the laggards are the really defensive names. XLU utilities, XLP defensives. And the REITs, they're flattish for the day, be it in the green. Again, no chasing of yields today. We saw that yesterday. That's another theme. Yesterday was chasing dividends, chasing yields. Today it's a different theme. Today it's chasing momentum in AI and chasing the dips, buying these dips in the laggards, be it oil, be it banks, be it industrials. Moving on to charts, and then we wrap it up. We start with the SPY, the S&P 500, 30 minutes chart. What do we see here? The bear flag from yesterday played for about 5 seconds in the morning, and then came the slew of buying by the institutionals, the retail, the algos, everybody. The 0-day till expiration options, huge pop higher above 420, an important number, and a closing above is critical for the market to keep. But the market went all the way to 422, which is a previous high. Couldn't make it, and it closed below that number. We look at the RSI, it is overbought again. So is the MACD. We could see a pullback based on the employment report tomorrow. But the most important line to keep is 420. Closing below 420 by the end of the week, which is the equivalent of 4,200 on the SPX, would be a loss for the bulls. Would it be a gain for the bears? A tiny bit, but not conclusive yet. We look at the E-mini futures, the daily chart. What do we see here? Still facing 42.32 as resistance over and over and over again. The chart went down and retested support at 41.80, but is it enough to crack above 42.32? We need to see more days like today. More buying, more inclusive buying, not just the AI crap. But oils, industrials, metals, banks, we haven't seen any sign of sustainability in that kind of buying. So for now, the S&P remains stuck within a range. But of course, it is a different picture in the Qs. 30-minute chart, we see the breakout above the sloping line of resistance. The Qs right now flying high with no resistance, actual legitimate resistance so far, besides the prior highs from last month. If that sticks, we have signs it might stick. Let's say the jobs report comes out hot, the dollar rebounds along with yields. We see the Dixie down in a retest to 348.40. If it fails, then we have 345.58. If that fails, then we get a confirmation of a reversal. Look at the MACD indicator. It's about to change momentum. The RSI is in negative divergence right now, but all preliminary signs, not conclusive yet. Now we look at the daily chart for the continuous contract for the Nasdaq. It is battling the resistance at around 14,445, but we talked about the importance of 14,000. The RSI is way overbought. It's about to become overbought in the weekly too. MACD's reaching the ceiling here. So again, my hunch is this is a topping process right here, and we're going to go down and retest to 14,000 sooner than later. My 2 cents, if you want to chase the AI mania, if you want to chase the Qs and the Nasdaq, the big caps, wait for a pullback to 14,000. You're gonna get it. If that holds, you're good to go. If it doesn't hold, we got a problem. IWM, 30 minutes chart for the Russell 2000. What do we see here? The negative trend from yesterday played for about 5 seconds in the morning. Then came the dip buyers, the institutions, retails, algos, and pushed the chart above 174.22. So we have to be bullish now on it. Above 174.22, we're bullish. Below, we're bearish. But am I going to buy it right now? No way. I need to see more. I need to see the chart closing the gap at 177.30 and moving above that number. Then we can say, okay, we're in the clear. The worst is now behind us in the IWM. Dixie, dollar index, 4 hours chart. What do we see here? Negative divergence, broke the pattern, broke support at 103.8, but is it becoming oversold now? The answer is probably. And if we get a hotter jobs report tomorrow, we could see a rebound in the dollar. So you got to be really careful with gold because right now it looks like it kept the support at 1928. Certain chartists have it at 1930. Doesn't matter. It is a zone. But we caught a rebound for now. But if the dollar rebounds tomorrow, we could see a reverse ABC pattern. So you got to be really careful with gold here. I would not be a buyer. I bought some miners this week just as a trade, NEM, New Mount Gold, but I'm not going to buy the commodity until I see 2000 recapture this support. Perhaps a better buy is SLV, silver. It was way overbought and it managed to recapture 21.57 as support. But again, you got to be mindful. If the dollar rebounds, we could see SLV moving down in a retest to 21.57. But a more bullish SLV silver versus gold, at least for now. Here's Brent, a daily chart for oil. What do we see here? Keeping the triple bottom for now. And this is absolutely critical. Now, the weekly closing, oil bulls would love to see some short covering and a close above 77 by the end of the week. Because at least you're going to breathe a sigh of relief this weekend. But if we close below and OPEC Plus doesn't deliver on Sunday, you're going to wake up to maximum pain comes Monday. The message is, make sure that you have your hedges on in case you're long oil. We look at the 2-year yield. What do we have here? Closing the gap. We got the pullback we talked about over the weekend. Now comes, what are we going to do with the employment report tomorrow? If it comes out really hot, we could see an ABC pattern. And the 2-year marching higher to make a higher high. And that will go against the face of Powell and company who are talking about a skip now. Anyways, we look at the TLT daily chart. What do we have here? Reversal in momentum from negative to positive on the RSI and the MACD. But it is facing resistance at 103.5. Can you trust it? The answer is you can't. If the non-farms come out hot tomorrow, 10 years is going to blast higher, TLT goes down again. VIX 4 hours chart. What do we see here? We talked about the possibilities yesterday. VIX bulls would look at this as, oh, we're making a higher low. And the VIX will march all the way to 20. Volatility bears would say, no. You're making a head and shoulder formation. And I said, I'm not going to engage in this debate. All what I know is support 17, resistance 18. If 17 is broken, that's bearish volatility, bullish equities. If 18 is broken, bullish volatility, bearish equities. For now, we're going back to the lows of the year in the VIX, which is bullish equities. But look at what happened last time we got there. Volatility moved higher. So are we about to see the same happening again? That is a possible scenario. For now, there is no indication, looking at this chart right now, that we're going to rebound from this point right away. Or the frenzy continues in the stock market and we see the VIX going down to 15. And folks, if it does go to 15, I'm going to be a buyer with both hands. Meaning the VIX, of course. But I'll be a short with both hands on the Qs, the AI mania, the overbought names. Here's Apple, the big kahuna, an hourly chart. What do we see here? I gave money managers an advice. You know when your client's crying to you saying, hey, buy NVIDIA, we missed out. If you buy NVIDIA, you're buying really close to the top, but you're buying at really bad prices, which is going to come back and hurt your clients sooner than later. So why not buy the dormant? Buy Apple. It's at 175. It goes to 180, book some profits, look back at your clients and say, look, we made money from Apple. At that point, they become more receptive and more reasonable. You see, as a money manager, your job is not just to manage money. Your job is also to manage psychology and to manage expectations. In many ways, you're a babysitter if you happen to be an active money manager. But buying Apple was a good strategy for the week. Now it's time to book profits and see what happens next. Tesla, 30 minutes chart, what do we see here? We talked about 207 as a critical number. The good news for the bulls, they closed above it. The bad news is tomorrow we're going to get to the expiration date of the majority of these call options, and then what happens? If there's no buying, if there's no following up, we're going to go down in a retest to 200. The market maker would love to see a retest to 200 because at that point, even the longer expiration calls will be tested. We look at the daily chart for Tesla. We have a breakout above a sloping line of resistance. But is it a false breakout now that the chart is becoming really overbought in the RSI? Well, we'll know because we're going to get a retest to this line. Sooner than later, and this could happen as soon as tomorrow, we're going to get a pullback in Tesla in a retest of that line. If the retest is good to go and we see a bounce, then you got to be bullish Tesla. If the retest doesn't hold and we see a crack below this line that becomes resistance again from support, and then abort, you got to be bearish Tesla. It was a false breakout. And that's all there is. Last but not least, Bitcoin tulips. What do we see here? We got a pop a few days ago. We thought it has legs. But again, it seems that there is a lack of momentum in Bitcoin. Maybe if Bitcoin says AI, it's going to be exciting again. But right now, it's not exciting. Can you be bearish on Bitcoin and say, okay, I'm going to short it right now? The answer is not quite, because you got to wait for 26,555 to be broken for sure as support. Because the bear case for Bitcoin is, if you've been holding Bitcoin, let's say since March of this year, you're not really up that big, you're flattish. Bitcoin has been consolidating, doing nothing at all. Meanwhile, you look at NVIDIA, look at AI, you look at the chips, you look at the big caps, all blasting higher. And the FOMO starts to kick in. And now the holders of Bitcoin year to date are up 60% or so. They might say, okay, this horse is not running. I'm going to book profits from this horse and rotate to the horse that is running right now, which is AI chips big caps. Could be a mistake, because they're buying at the top. But the point being here is, if it plays out, it would be a negative outcome for Bitcoin. It's going to lose support, and we're going to see a flush down all the way to the 24,000, 23,000 range. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the big one. That's it. The non-farms comes with the unemployment rate and hourly wages. All eyes on the non-farms. We'll be doing it live, ladies and gentlemen, 5:30 in the morning Pacific time on Discord. Either you're here or you're not. But with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Take care.
Turn on Smart Relief and turn off pain.
Wonder all you like.